but it's the uncertainty index for the United States. You can see that it has spiked with higher rates and tariffs and all the drama around politics and so forth. It's improving, but is not down to where it has been historically. And again, all of the uncertainties. Businesses are uncertain. Am I going to lose my business to AI and automation? So it's not just employees, it's businesses who are uncertain. Again, another reason for the velocity of money to drop.
Hey guys, welcome to Everyday Finance. These kinds of moments are rare. Every few decades, economic forces and innovation clash to redefine growth. Cathie Wood of Ark Invest claims that we are currently living in a time that is similar to 1995, before the internet revolution revolutionized the world economy. The norms of commerce were rewritten in those days as markets soared on optimism and new technologies. Cathie contends that an even greater wave is coming, one that is driven by blockchain, AI, robotics, and nuclear energy. She anticipates real GDP growth, surprise to the upside, productivity increasing, and inflation dropping. In contrast to the prevalent fears of stagnation, she thinks innovation and deregulation might turn deficits into surpluses. Much as robust growth did in the 1980s and 1990s, long suppressed by regulations, nuclear energy is again gaining traction as artificial intelligence AI increases demand for electricity and processing capacity. A new era of productivity might be fueled by small modular reactors, sophisticated storage, and more open tech and cryptocurrency marketplaces. Cathie defies the conventional wisdom of catastrophe by outlining a roadmap in her most recent podcast that emphasizes growth, innovation, and opportunity.
On to the next chart. So monetary policy, is it tight or easy? This chart, which Dan Rodriguez at ARK pointed us to, is the yield curve as measured by the 2-year Treasury yield relative to the 3-month Treasury yield. And anything below zero, which you see here, is tight monetary policy. And you can see it has been tight for a very long time. And we think this is going to have disinflationary, if not deflationary, ramifications with time. And it certainly fits into the narrative that President Trump and the administration have put forth, like, hey, don't you see what's going on here? And on the next page is a different version of the yield curve. It's the 10-year Treasury minus the 2-year Treasury yield. Now, this is in positive territory, but if you look at past recessions, and those are in the shaded areas here, the steepening of the yield curve after an inversion tends to occur during a recession. And as you know, we've been talking about this rolling recession for the past 3 years. Manufacturing's been negative for the past 3 years. Housing has been decimated over the past 3 years. The low and middle income consumer has been hurt badly during the past 3 years. Higher interest rates, higher food prices, housing affordability, so very difficult times. Now, what I find interesting about this chart is, sure, again, we're in this rolling recession. We think it's the final leg of the rolling recession. And what I'm eager to understand, as the Fed cuts rates, this will continue to steepen. But if you look at the trend since 08-09, the trend has been down towards a flatter and flatter yield curve. We didn't get back into the 200 to 300 basis point range as the Fed was flooding the economy with money. We didn't. What was this pointing to? And we think there's an underlying deflationary narrative building into the yield curve. We'll see if we get above the 150 with this easing cycle, and we should know by the end of the year. If we don't, what that would tell us is that this deflationary narrative, I keep using the word narrative, that we have, it will raise the probability that that is correct. And that is the long bond picking up on that and not increasing as much out of fear of inflation as the Fed eases. So stay tuned on this one. It should be very interesting. Inflation, okay, lots of fear about it. This is trueflation, the trueflation CPI, and as of this morning, again, this is a real-time measure, and it's tens of thousands of goods and services in real time, constantly. Today, we're at 1.9%, and that's with tariffs getting into the inflation rate. They're certainly reflected in here, and I think everybody's expecting a big burst of inflation because of tariffs, and so far it hasn't happened. And what I just discussed in terms of fear and velocity slowing down and all of that could be a reason. Here are consumer inflation expectations. So University of Michigan inflation expectations went wild. Not so true on the Fed's measure of inflation expectations. So UMich is a 5-year expectation, and it's up there at 3.5% over a 5-year period. The Fed's is a 3-year, it's at 3%. We think both are going to come down dramatically during the next few years for reasons I have already described. And I do think UMich, and I relied on that survey for gosh, they started it, I think, in the early 70s. I wasn't in the business then, but for my entire career, I've relied on it. It has been much more reliable at turning points in the cycle than other metrics. I think it has failed us this time, and it seems like a change in their survey methodology has really hurt that particular metric. Here is economic uncertainty, and I think this is a Fed measure, if I'm not mistaken, but it's the uncertainty index for the United States. You can see that it has spiked with higher rates and tariffs and all the drama around politics and so forth. It's improving, but is not down to where it has been historically. And again, all of the uncertainties. Businesses are uncertain. Am I going to lose my business to AI and automation? So it's not just employees, it's businesses who are uncertain. Again, another reason for the velocity of money to drop.
Cathie begins by discussing the deficit, which is a constant worry for investors. She points out that tariffs and fiscal changes are already relieving tensions. With the deficit running close to 4.7% of GDP, despite headlines warning of unmanageable debt. However, history demonstrates that expansion, not austerity, is the true remedy. Similar to the 1980s and 1990s, deficits can naturally decrease with robust real GDP growth. She contends that expansion is now feasible. Markets are underestimating the productivity benefits that are being unlocked by innovations in AI, robots, energy, and blockchain. These pressures, when paired with deregulation, may prove to be the most potent instruments for reestablishing fiscal equilibrium. The assumption is that the United States is entering a new economic cycle at a rapid pace rather than slipping towards stagnation. But expansion also brings upheaval. The labor market, job creation, unemployment, the development of AI are already changing the nature of work itself, is Cathie's next area of interest.
Of M2 velocity, that is the green line, and mapped against the labor participation rate. Now, velocity is the rate at which money turns over. And in 1997, it peaked in the United States. And it had been increasing secularly for decades. It peaked, and as you can see, it has been falling for the last 25 to 30 years on balance. Now, it is cyclical. When we go through a downturn, a recession, velocity drops, and you can see here it collapsed during COVID. Why? Because people were very afraid, and so they held back their on spending, especially in the beginning, thinking that we were all going to lose our jobs, the world was entering a global depression, and we needed to save money, save it for that very rainy day. And so it collapsed. Cyclically, it has moved up, but it moved up. If you were to look at a longer term chart, and we'll provide that in the next In the Know, it has moved up to where it should, and now it is starting to fall again. And we think there's reason for it to continue to fall cyclically, but this chart explains why it has dropped secularly. As the labor force participation rate has declined, velocity has declined. Now, what may explain that? Maybe 2 income households moving down to 1 as they have children. That's a possible explanation. In terms of other explanations, some of it is they don't declare they're in the labor force. They are in the gray market, and so that's a possible explanation as well, whether it involves immigration or what have you. And I'm sure there are many other reasons, but this is the only relationship that we have found to explain the decline, the secular decline in velocity. So if the velocity of money is rolling over again, then that is going to diffuse money of its inflationary power. It takes away from that inflation risk because, again, the rate of turnover in money goes down. Savings rates go up. People are more conservative. And from a cyclical point of view, we also think velocity is falling because, and we'll get into this more with the labor report, there are a lot of people who are afraid of losing their jobs because of AI, and that's in the higher income households and automation generally, and that's probably more on the manufacturing level. So I think there is concern out there. It's a question when I go around the world, everyone asks about, jobs being displaced and destroyed by robots and AI. And our answer from a secular point of view is technology is a net job creator. Sure, there's displacement in the short term, but these displaced jobs are usually mundane, boring, not interesting, tedious, and there are two phenomena today that will offset any of this displacement. We have baby boomers retiring at an accelerated rate, and if you think about truck drivers, a lot of baby boomers have been the truck drivers, and there are big shortages there. So autonomous trucking, we think, is going to become very important in alleviating that labor shortage. So that's one good example. And then, of course, there has been, I think, if I might have this number wrong, but the number of people leaving this country because for reasons associated with immigration, whether it's illegal or fear or what have you, is in the 1 to 2 million range. And again, many of those jobs are in mundane areas that automation will help us improve, whether it's paperwork or leisure and hospitality work. So I think this couldn't happen at a better time, given those demographic shifts. Again, though, that said, and I suggest you do this exercise. Go to ChatGPT or Grok and ask it, prompt it. We're all programmers now. We can prompt it with natural language. What kind of jobs will automation and AI create? And in the prompt, suggest that it consults science fiction, futurists, technologists, economists, strategists, and then answer that question. And you will find a very long list is the output. One of the jobs that I find interesting, because again, it gets us thinking, wait a minute, there are whole new spaces being created, literally here. So one is asteroid mining, right? So think about space. What kind of jobs are we going to see created there? Think about blockchain and the digital world. Now that we have immutable digital property rights online, didn't have it before, but now that we do, and, you know, in a game, someone can win a Gucci skin, and it's their skin, and theirs alone, and there's proof of that. That is how a lot of young people are deriving social status these days. And that's a whole new world that is just now being monetized. I think it's one reason also we're going to see Roblox continue to flourish because it is so many things. It's not only a social site, a gaming site. Young people are actually coding and they don't even know it, and they are starting new businesses, learning how to run them. So it's pretty exciting what's being created out there, but I have to tell you, I go around the world and there's just so much fear. Again, a reason we think velocity could continue to fall.
The unemployment rate is stable at 4.3%, but job creation is slowing. The revisions are turning some months negative, and work weeks are getting shorter, according to the most recent jobs report. Finance and technology are disrupted, but manufacturing remains poor. These are warning flags for the majority. Instead, Cathie sees them as signs of structural change. Blockchain reducing inefficiencies, AI automating tasks, and even government layoffs, indicating reduced spending. Short-term discomfort, but they are seeds of increased productivity in the long run. The similar theme runs across her market view. Although there are still pockets of excess in bonds and commercial real estate, inflation has subsided, rates are leveling down, and credit spreads indicate little short-term stress. In light of this, she contends that innovation is still the real motivator. She underscores both the dangers of overexuberance and the far greater possibilities now by drawing a comparison between the adoption of AI and blockchain today and the internet boom of the 1990s. Her view is remarkably optimistic for cryptocurrency investors. Bitcoin's potential significance in a new economic era, its rapid institutional adoption, and its durability against gold all suggest that digital assets may soon become a mainstay of international markets. The upcoming wave of AI and blockchain could change wealth creation on an even bigger scale. Similar to how the internet era gave rise to trillion-dollar behemoths, if Cathie is correct, this marks the start of a new cycle rather than its conclusion. It's possible that the next 5 years will be far more revolutionary than people anticipate.